Bitcoin is way too volatile to ever be a store of value, at least what the so-called experts want to say. However, in this video, I'm going to break down what volatility is and actually why it could be a good thing if you know how to use it properly. If you watch this video at the end, I'm going to tell you exactly how you can use volatility to your advantage. So stay tuned. All right, welcome back. So today we are going to talk about Bitcoin's volatility and why it's a good thing. Now, it's probably different than what you're imagining. I'm going to explain that to you, and at the end, I'm going to show you exactly how we're going to play this volatility to our advantage. All right, now, if you're new to the channel, on Thursdays, we talk about investing in cryptocurrencies, which I believe the most explosive asset class that we have today that we'll ever see. And on Tuesdays, we talk about before you're investing, ways that you can make more money, save more money, so you can invest more. All right, now today, this episode is being brought to you by my new sponsor, CoinStats. It's a cool way to track your portfolios and look across the entire marketplace. And so I'm just gonna show you what that is real quick, so here we go.
All right, so looking at the CoinStats platform at first, it kind of looks like CoinMarketCap. You got your light and your dark mode, and you have your assets here, and you can look at the changes, and you can sort by any of these headers just by clicking on them. But what happens is when you click inside to one of these, you get your typical charts, which is pretty cool. But what they have unique is they have these insights right here. And this shows me how many CoinStat users are holding Bitcoin, the dominance of that in their portfolio, if they're being held on wallets and exchanges, and what percentage is being traded today. And so this gives me unique insight into the market and shows me, is it more bullish or bearish? What's going on? Are people trading it? You also kind of have this poll up here at the top to gauge the market sentiment, which is always important. And then down below, we have news that's specific to the coin that you're looking at, which is pretty cool. Another feature that I really like that I've been using is the portfolio tracker. So you can set up different portfolios if you want to track them differently, enter the coins that you have in that portfolio, the date you entered them, how many coins, the purchase price, etc. And so then you can track your performance or your profit and loss. And you can track your profit and loss here, but you also have these drop-down filters they've recently added where I can look at profit and loss over different time periods. I can also look at the breakdown of my portfolio in a pie chart, which is pretty cool. So some cool features. You can also trade directly from here. You can connect your exchanges to get your accounts updated in real time and also trade directly from CoinStats, which is pretty cool. So check them out.
All right, thanks for checking that out. Go to CoinStats and check that out if you think it'd be helpful for you. Track your portfolio there. If you want to upgrade to the Pro subscription and use the app and all the additional features, I have a discount for you. Click on the link down below in the description and check that out. Now, what we hear almost everybody say is that Bitcoin is too volatile. That means it goes up and down way too much to be a store of value. Why would you want to put all your money that's going up and down all the time, right? That's what they say. So like, if I'm going to take it in today and I take, $10,000, but then it's worth $8,000 later, like that'd be a horrible store of value. But in order to really address that, we have to break this down. I always take it back, right? We have to go through a little bit of history. So let me explain this. So first of all, we have to understand the narratives. Bitcoin has narratives. So what I mean by that is how we talk about Bitcoin, what we say. So really, Bitcoin started as like a digital cash. And so that's cash that just be freely traded and used. But now today, the narrative or how we talk about or how we think about Bitcoin has changed. And now today, it's all about Bitcoin being a store of value, means somewhere that we store our wealth. And in the last video, last week, we talked about the evolution of Bitcoin, the evolution of money, and how it evolves from a collectible to, through speculation, through investment, and eventually into a store of value. And so it's a little bit about kind of like that. But in order to get to those stages, in order to go from a collectible into a store of value, we have to have volatility. Volatility is natural. Anytime we have a new asset or any kind of new technology, we're going to have this volatility. The volatility, the price going up and down, is price discovery, right? Bitcoin isn't alone in this. Any asset, any technology has gone through this same process because it's about supply and demand. At the end of the day, I learned this when I was a kid. I think most people did. At the end of the day, it's about supply and demand. and the price is trying to be found. And in the beginning, we have this new asset, this new technology, and we don't know what that price is. And so it's being traded, and that's that price discovery, as we call it. And so just like any other asset, we have volatility. Now, again, volatility is the price going up and the price going down. Now, if you're investing into something, you want the price to go up. You want volatility, right? We want upwards volatility. Maybe we don't want downward volatility. But at the end of the day, investors, we want volatility. And so we have to understand that, just because it's volatile doesn't mean that it can't be a store of value, right? Just because it's volatile doesn't mean it won't ever become a store of value. And just because it's not volatile doesn't mean it is a good store of value, right? So the same is true. So you can't just go, well, this asset, whatever it may be, because it's not volatile. So take the dollar, for example. The dollar is not volatile, but it's not a good store of value. Right? The opposite isn't always true. So just because something is volatile doesn't mean that it can't be a good store of value. Like I said, we can look at the dollar as a perfect example of this. Now, the dollar is controlled by central banks, and central bankers sit around and plan, and they try to manage this. They try to manage the volatility. And the problem with central bankers is that they think about the short term. They think about days, weeks, maybe months. They don't think about years. So if you look at the dollar over years, as you can see in this chart right here, the dollar's actually lost over 90% of its value. Does that sound stable? It's lost over 90% of its value. Now, if you look at it over a day, a week, and a month, it looks really good. But when you look at it over 20 years, it looks horrible. It's a horrible store of value. Imagine in 1950, if you had enough cash to buy a home and you said, I'm going to buy this house cash, it's $25,000, but I don't know if I'm ready to buy that house right now. So I'm going to put that $25,000 in the bank. And today you're like, okay, I'm ready to buy that house now. I'm going to pull that $25,000 out of the bank. It's not going to buy you a house. It's not going to buy you anything. It's not even going to buy you a car. And so that's why it's a horrible store of value. So it looks really good in the day, week, month, but it doesn't look good over time. And so these so-called experts, these central bankers, the Bank of England, the ECB, Bernanke and Yellen from the U.S. Fed, Mnuchin, the Fed chair right now, Trump, president, right? They all talk about this. And they say that Bitcoin is too volatile, it's flawed, it's not good, and it's not a currency, is what they say. But at the same time, as you can see in these tweets right here, we have the Bank of England tweeting out that they could create as much money as they need to buy assets. The central banks are saying over and over, not just the Bank of England, all the central banks want to create as much money as they need, as much money as they can, as much money as they want to buy all those assets. But that's exactly what makes currency lose value. That's exactly why money is a poor store of value, because they can create as much as they want to buy any types of assets. So Bitcoin is the opposite of what central banks do. So, Bitcoin is anti-fragile, we call it. It hasn't been killed. I made a video, right, the Lindy effect. The longer something is alive, the longer something's around, the more likely it is to stay around. So every single day that it's around, the more likely it will be to continue. After it survived the first bear crash and it didn't go away, it made it very hard to kill. Now it's gone through several of those, and it makes it more and more resilient. So Bitcoin is anti-fragile. It's not going to be subject or saved by bailouts, which means it's not going to have moral hazard where people get the money and they don't take care of it. They do bad things with it. Like I said, the central banks, they're really trying to focus on the short term, not the long term. So really what the central bank is doing is they're trying to manage on the short term to get rid of any volatility. So they're constantly adjusting interest rates, adjusting the supply, and they're pulling their levers and twisting their screws to try to get rid of any volatility that they have. All right, but what that does is it creates instability and it creates long-term volatility, right? So like we talked about, in the short term, it looks very volatile, but if you look at the dollar over 20 years, 30 years, 50 years, 100 years, it looks horrible. It's been massively unstable and losing lots of money. And so we have to understand, like I said at the beginning, that all value, the valuation really is always going to come from supply and demand. So the central bankers can sit there and try and tweak the screws, and they do, right? So they increase the supply, right? So that's the supply. And then by adjusting the interest rates, they try to change the demand. When they lower interest rates, they expect there to be more demand, or they can increase more money at the same time. but they're doing both at the same time. They're printing more money or putting more money into the system as they're lowering rates at the same time. But they're trying to manufacture, they're trying to manage these market forces that are natural, and they can't do that. And this is exactly what Bitcoin's doing, and this is why they don't like it, because they can't manage the natural forces of supply and demand on Bitcoin. Because Bitcoin, it can't be manipulated, right? So as the value of Bitcoin increases, it becomes more relevant to new people, more people find out about it, and it creates this cycle. So the price of Bitcoin goes up, more people talk about it. More people talk about it, they Google it, they get education about it, they buy it, right? More people buy it, the price goes up. More price goes up, but people find out about it. And it's this cycle, right? And every time it goes up, more people talk about it, and it finds these new pockets of adoption, these new people that weren't interested in it before. For example, 2015, 2016, the institutions weren't interested in it, but today they are, because the price has gone up enough. And so it's supply and demand. And really, through this process, it creates these waves, or we call these adoption waves. And this is why it's volatile, right? So we go from zero, right? We go from zero to today, about $10,000, $11,000. And it doesn't go from zero to $10,000 or $11,000 in a straight line. It does that through volatility by going up. Volatility is going up. And as it goes up in value, it creates more awareness, it reaches more adoption, and it keeps hitting these pools. And you hit a new pool and it opens up even more. Then you have a little bit of pullback. Then it goes up a little bit more, reaches new people, you hit this new pool, and it creates new infrastructure. So every time the price goes up, it brings more awareness, more adoption, and then we bring more infrastructure. And we can see this every single year. More wallets, more second layer scaling solutions, more exchanges, more cashback programs, lending programs, you name it. And so we're constantly seeing this infrastructure. And then, of course, by having the infrastructure, it fuels more adoption. And then the more adoption brings the price up, and the more price up brings the knowledge up. And it's just this cycle that goes and it goes round and round and round. And that's how we went from zero to where we are today. It's just a process. But what we have to keep in mind is that over time, as this grows, as we get larger, as we get more market share, as we get more people in, as we get more money, the volatility will start to go down and down and down and down and down. Like this screenshot that I have up right now, like throwing a rock in a pond, right? So imagine if you had a rock and you threw it into a very tiny pond, or maybe a bucket, right? It would make a giant splash. But the larger the body of water, the larger the pond, or eventually you throw it in the ocean and it's barely going to make a splash at all in comparison to how big that body of water is. And that's kind of what we're seeing with adoption and volatility today. So right now, adoption is about less than 1%, right? Less than 1%. The market is super small. So imagine when you bring the first billion people into the space, how big of an impact that is, how much that pushes the price up, how volatile that's going to be, as all those people are trying to figure out what that price discovery is. But as the market grows and grows and grows and grows, the impact will be less, just like getting a larger body of water compared to that single rock. And so if we look back through the history of adoption, and we won't go all the way history, we don't have real good numbers on that, but as best as we can tell from like the end of 2016, beginning of 2017 to the present, the market's estimated to have grown about 12 times, 1,200%. And we've gone from about 5 million people to about 60 million people in that time frame. So about 2 years, 2.5 years. And during that time, the amount of people involved have gone up 12 times, 1,200%, but the supply has only gone up by 10%, right? So we have way more people coming in, demand, but the supply is going up very small. So the logical result to that is going to be volatility. That's what happens. Volatility, pushing the price up. People buy it, the price goes up, they want to sell it, the next person buys it, and the price discovery goes on and on and on. And the buyers and sellers, it equals a small percentage of the base at the time. But as that grows, it's going to be less and less and less volatile. Now, I want to tell you what we're going to do about that, how we can play that. But before I do, just imagine this quote right here. Just imagine when we're looking at Bitcoin that there exists this brand new, never have we had this technology before. There's a global network through which you can transfer value over communication to anyone in the world. Transfer value through communication to anyone in the world. And right now, today, it's currently valued at less than $200 billion. Imagine how crazy that technology is to transfer value peer-to-peer instantly anywhere in the world. We have that network today. It's valued at less than 200 billion. Facebook alone is worth $500 billion. So think about how small this really is, how early this is. Now, we'll tell you how to play this volatility, but if we want to future cast this just a little bit, first of all, nothing's guaranteed. Tomorrow's not guaranteed. We don't know about tomorrow. So failure is possible, right? This is a new technology. It's a new asset class. Failure is possible. Like I said, with the Lindy effect, the longer that something is around, the more likely it will be to be around. However, nothing's guaranteed. Failure is possible. But like I said, every day it's less likely. Now, I believe that we'll go through this evolutionary cycle where today we're still in this collective, collector's kind of speculator asset, eventually get to the store value, eventually get to a medium of exchange. So we'll get there, but we're not there yet. So today, because it's not really the best medium of exchange, we don't really want to be spending it. We don't want to be spending Bitcoin. We want to be spending our deflationary currency. Like I said, a dollar is losing value. Now, the US dollar has lost 90% of its value, in the last 100 years. But like in Argentina, they just lost like 25% of their value in their dollar, like overnight. 25% overnight. Imagine that. Imagine just losing that much of all your money overnight. It's incredible. So we have all these fiat currencies, these dollars, and they're losing money. The longer we hold them, the more they're losing money. And so we want to spend those depreciating assets, and we want to buy appreciating assets. So Bitcoin has been an appreciating asset. And as a matter of fact, over the last 1 year, 2 year, 3 year, 5 year, 10 years, it's been the best performing asset in the world. Now, you could take any small little chunk of time and you could say, well, from January 2018 until July of 2018, it was horrible. And you would be right. But over a long enough time period, remember, right, the central banks try to optimize for days, weeks, and months. We're looking at it over time, over years. And when you look at it over 1 year, 2 years, 3 years, 4 years, et cetera, it's been the best performing asset class. So we want to spend our depreciating assets and we want to buy appreciating assets. And eventually that store of value will come, especially when we're looking at it over that longer time horizon. It will become less volatile as more and more and more people come in. It becomes less volatile. So like I said, imagine, we have about 60 million people, and imagine the first billion people that come in, how big of a splash that's going to make on 60 billion. To go from 60 billion to, 60 million to 1 billion. Imagine the splash that will make. But once we have a billion people, when you add another 60 million in, it's nothing, right? And so as it grows, the impacts will be smaller and smaller and smaller. So how are we going to manage this, right? That's what I told you at the beginning. We talked about. So how do we manage this? A couple things. First of all, we do it through diversification. So volatility is not a bad thing. To answer the question from the beginning, volatility is not a bad thing. Volatility is a good thing. We want volatility. We want our assets to go up. If everything stayed flat, that wouldn't be good. So we have to manage the volatility. We want to be prepared to take advantage of the upside, but we want to manage the downside. And so we do that through diversification. And so we don't put all our money into one asset. We put our money into different assets that have different levels of volatility to help balance each other out. We do that through allocation, but we also do it through different time horizons. All right. So like I said, the time horizon is how long you're looking at it. So if you're looking at Bitcoin over a 5-year or 10-year or 20-year period, the risk tolerance is different than if I'm looking at Bitcoin over the next month or two. Like if I need, I need money to pay whatever expense in 30 days from now, but I'm going to put it into Bitcoin today, hopefully it goes up. That's super risky. It could go down, but the chance of it going up over the next 5 years or 10 years is extremely high compared to the risk reward ratio. And so we'll do it through portfolio allocation, time horizon, and then we want to risk adjust our portfolios. Now, this gets into some deeper topics that I can get into. If you want training on this, leave it in the comments down below. But it's about figuring out your overall portfolio balance and then putting in the right risk adjusted amount. So for example, you could put just 1% of your portfolio into Bitcoin, and when Bitcoin goes up by 100%, it returns to your total portfolio. When you look at your total portfolio overall, So you might want to put 5%, 10%. Anthony Pompliano was on TV with Mr. Wonderful for Shark Tank. He said he put 50%, which Mr. Wonderful said he was absolutely out of his mind and crazy, and it is extremely high, and I don't recommend anybody do that. He's an experienced investor. He has time on his side. He's young, and he makes a lot of money. So you have to take all these considerations into consideration for your own specific use case. But diversification, portfolio allocation, using your time horizon, and using different weighted percentages in your portfolio based off of your risks. Now, again, these are deep concepts. If you'd like more training on this individual stuff or the specific stuff, leave it in the comments down below. We can make some more videos on this to help you out through that. All right, so that's it. Volatility is a good thing. We want the price to go up, but we need to manage it for the downside. We want to look at it over a long enough time horizon. Leave me a comment. Let me know what you think down below. I'll answer any of your questions. Give me a thumbs up on this video if you liked it. If you don't, give me a thumbs down on the video, but I'm sure you liked it, right? So give me a thumbs up. All right, that's it. To your success. I'm out.